Evergrande is the largest property developer in China and was recently among the most valuable companies in the world. Now, many experts believe it's close to collapsing financially and won't be able to manage its enormous debt unless the government steps in very soon. This isn't just another corporate bankruptcy. Evergrande directly employs over 200,000 people and indirectly supports up to 4 million subcontractors working on thousands of construction projects each year. The collapse of such a company could have major consequences. Beyond jobs, the company also holds deposits for about 1.5 million homes that may never be delivered. These homes were paid for by everyday Chinese people who either wanted a place to live or to invest their savings. Losing a home is devastating anywhere, but in China, it's even worse. Housing prices are extremely high compared to the average income, and many families spend years or even generations saving for a deposit. Because of this, real estate has become the main form of investment for most people. So if over 1 million citizens lose that investment, the financial shock could spread across the entire economy. And yet, despite these risks, the Chinese government has so far refused to bail the company out, mainly for political reasons. To really understand what's going on, we need to look at three things. First, how a company that seemed healthy fell apart. Second, what the worst-case scenario looks like without government help. And third, whether the crisis will stay in China or spread globally. Many are calling this China's Lehman moment, referring to Lehman Brothers, the U.S. investment bank whose failure in 2008 helped trigger the global financial crisis. The situations are similar. Both companies were huge, had massive debt, and used questionable assets to back it. In both cases, governments hesitated to act. While Evergrande isn't a bank, in China's system that could be even riskier. Property is the main thing people invest in, unlike in the West where investments are more diverse. It's like combining Wall Street and the housing market into one high-risk sector, similar to what happened in 2008. Chinese regulators saw the risks of a property bubble and started enforcing new rules in August 2020. That's when Evergrande's real problems began. In China, land isn't owned outright. It's leased from the government for long periods, usually 70 years. Developers like Evergrande buy these leases, design buildings, and then pre-sell units to ordinary citizens. Buyers put down deposits, and that money helps the developers borrow more to fund construction and acquire new land. This model fueled rapid growth. Evergrande was able to constantly expand, using money from new buyers to fund new projects. Investors received good returns, and lenders felt safe since they could repossess valuable property if anything went wrong. The company was profitable, had more assets than liabilities, and kept growing. But Evergrande pushed the system to the extreme. They assumed property values would keep climbing 10 to 15% each year and borrowed aggressively to grow faster. The 2020 regulations changed everything. Developers were suddenly limited in how much debt they could take on and how they could use pre-sale funds. This disrupted Evergrande's business model, which depended on a steady stream of new money. To adapt, the company lowered prices on its properties to attract more buyers. It also kept some finished buildings on its own books as assets, borrowing against their value instead of selling them. That strategy worked as long as property prices kept going up. Holding on to a building for a few months usually made it profitable to sell later. However, the new rules forced the company to hold more unsold inventory while also needing to offer steeper discounts on new properties. That created two big problems. First, it reduced the value of the assets they used to offset their debts. Second, it made it harder to borrow money, which was essential to keeping construction going. As doubts grew over the true value of Evergrande's real estate, the company had to turn to over 128 banks and many non-bank lenders to stay afloat. Buyers started losing confidence, and large development projects that once sold out quickly were now being discounted repeatedly. As buyer confidence dropped, people became hesitant to purchase Evergrande properties. Even those still interested in real estate were waiting for even deeper discounts. This slowed down cash flow dramatically, cutting off the company's most important funding source. That led to even more discounts and growing concern over the real value of the company's assets. Now, Evergrande is in a critical position. It doesn't have enough cash to continue daily operations for much longer. In theory, it could sell off its existing properties to raise money, but due to the bad press and urgency, it would have to sell at major discounts. This would further hurt the value of its real estate holdings and cause even more trouble. If the government chooses not to step in, the consequences could be severe. The company would likely go into liquidation. The 1.5 million people who paid deposits for unfinished homes could lose everything. The company's massive inventory of properties would be dumped onto the market quickly, pushing housing prices down. Even in a country like China, which has a huge appetite for real estate, flooding the market like this would hurt prices. It would also put pressure on other developers who are in similar financial situations. As property prices fall, their assets lose value, making it harder to borrow money and finish construction. This could lead to more defaults and bankruptcies in the industry. This situation is eerily similar to what happened with mortgage-backed securities in 2008. If you swap the words Chinese apartments with mortgage-backed securities, it's easy to see why people are comparing this to a Lehman Brothers type collapse. Could this affect markets in the West? It's possible, but China's financial system is more closed off than that of the US or Europe, which means the direct impact might be smaller. Still, China is the world's second largest economy. If things get out of hand, the shock could ripple out globally. The Chinese government is likely aware of this and may act to contain the damage. After all, their political stability depends heavily on consistent economic growth. A major collapse could lead not just to economic trouble, but to civil unrest. This is a fast-moving situation, and no one can say for sure what will happen next. But now you understand the core of the crisis. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.